So the purpose of this presentation is to give a bit of an update on the debt presentation that I gave to the RTM in February of this year. Given the concerns that were mentioned before about our rising debt levels, I wanted to give you some background on the bonding process just as an educational matter, and then let you all know where things stand at the moment as these numbers will show you. So I'm going to do a couple of things. If I can get this slide to advance. Okay. A couple of projects, a couple of things we're going to talk about. I'm going to give some background on the bonding process and how that works, talk a little bit about some terminology and some of the key players that you've probably heard about but may not know how all that works. And then I'll give an overview of the town debt as to where it stands right now, sources of new debt, and then implications for the town in terms of debt service and our credit rating. So let's start off with bonding and some background information. So if you think about the town's capital spending requests, they really come from the policy-making boards in the town, and that's the Board of Selectmen and the Board of Education. For the Board of Selectmen, examples of that are Great Island, Public Works garage renovation, Pear Tree Point Beach, which you all just passed. These are all major capital projects, and they're capital projects that we would bond. The Board of Education does the same thing, like the Oxford School, renovations like HHR, but we also bond things such as roof repairs. It's important to know that in terms of process, the way we do this, that those project costs and the timing of those projects are incorporated in the town's 5-year capital plan, which you've seen before. But when those projects come up and it's time to move forward with them, we will introduce them into the budget process. And so kudos to Jack and Davis and Sarah Newman, who worked out the criteria for making sure that we stick with the budgeting process for all of our capital projects and try to do that in January, February when we do our budgets. If we do have to have an off-cycle request, there are certain criteria that have to be met to do that, like we have to do it right now in response to a disaster or there's some other timing-related issue. So in terms of the approval process for this, keep in mind that, again, Board of Selectmen and Board of Finance, those are the policy bodies for the town, and what they're going to do is they'll determine when it's time to proceed with a town or a school project. They will develop the case for action to try to sell that project and convince everyone that we need to do it. They'll also provide the details, the scope of the project, lowest cost bids, when they expect to have those projects done. And then, of course, they're going to approve the project, which both the Board of Selectmen and Board of Education would do. And then the Board of Selectmen will recommend a bonding resolution to the Board of Finance. So next up, the Board of Finance will play a different role. What they're going to decide is whether the project is affordable to the town and makes financial sense. They review current indebtedness. They'll take a look at our debt service, and they'll take a look at taxpayer impact. Their job is not to debate the merits of whether to do the project. Their job is to debate whether it's prudent to do so from a financial standpoint. They'll also consider things like funding options. So should we bond the project? Should we pay for it out of fund balance? And then they will recommend a bonding resolution to this body. And then finally, the RTM, you all have the final sort of review role in all of this. You're going to consider the project merits, the cost overall. You'll have different committees look at it. F&B will always take a look at it from a financial standpoint, but depending on the project, you'll have different committees that look at it. And importantly, you come up with not just the final bond authorization, but you'll appropriate the funds. So what happens after that? So after the RTM approves a bond resolution, the appropriation authorizes the town to begin project expenditures once the 10-day referendum period passes. So that's a provision in our ordinances that says if someone doesn't like a proposed spending authorization and appropriation, as long as it's more than $50,000, they can seek a referendum to have that decision overturned. Now the bar is pretty high for that. You have to get something like 5% of the total electors of the town to sign a petition, and then 25% of those electors must vote, and a majority of them must vote to overturn it. So it's a complicated process. We've not had one of those referendums since I've been in government. Now, once that process has expired, then the town or the Board of Education, they can start spending money on this. And by that point, we won't have bonded proceeds, so the money is actually going to come out of fund balance. But when the bonds go through, then the bond funds will actually reimburse the town reserves. That's why we can get started on projects right away, even though the bond itself will not have actually been put in place. Now keep in mind that a bond resolution, it authorizes the option, but not the obligation to bond. And if you read the bond authorization language, it says that we can borrow up to a particular amount, but we can decide that we don't want to bond something. It's not required that we bond the entire amount. You'll notice, though, that sometimes we'll do a bond authorization and the actual bonding doesn't take place for a while. And the reason for that is we want to accumulate enough projects that need to be bonded before we actually pull that trigger. It is expensive to do a bond. For example, one of the things that every bond, every time we go out to market for bonding, the ratings agencies will re-rate the town, and that costs us about $50,000 every time we do that. So you don't want to go out to market to do small bonds. You want to kind of let them accumulate for a while until we get to a critical mass, then go out and do it so that we don't have to go through that expensive re-rating process every time. So the idea is that you guys have appropriated the money, and then the town finance director is going to say, well, we've accumulated enough bonding needs, and then we're going to go out to market. Just as a way of calibration, the next time we plan to go out to market is probably in April of this year, and that's going to convert the bond anticipation notes for Great Island, as well as, if you all approve it, something like the Coons lot and a few other things. But that way we'll have enough bonding activity, if you will, to justify going to market and minimizing the cost of issuances. Okay. So now it's time to execute that bond. At this point, the Board of Education, Board of Selectmen, and the RTM have no further role in the process. Your job is done at that point. But the Board of Finance does have other things to do. So it's going to make the final determination as to whether to bond or not change the appropriation, just how we're going to pay for it, whether it's a bond or cash or something else. They'll decide the bond type. Most of the time we issue general obligation bonds, but sometimes when you're not sure how the property is going to be used, as in the case of Great Island, we'll issue what are called bond anticipation notes, or bands. Those are basically temporary financing that we put in place that's paid interest only. There's no amortization. It allows us to think about what we're going to do next before we put in the permanent financing. They'll also set up bond duration. All of our bonds right now are 20-year bonds. The only 30-year bond we have is actually for Great Island itself, but we do have the opportunity to vary the duration of the bonds depending on the expected life of the assets that we're funding. And then, of course, bond structure. Right now, the current Board of Finance posture is we'll put in place long-term financing. It'll be interest only for 2 years, and then it will be principal and interest after that. 2 years of interest is actually as long as you can go. You can't go any further than that on permanent bonding. And then finally, you'll get to bond, the point where we actually put the bond out for sale. That process starts about 90 days before the auction, and that'll include things like the re-rating by the agencies, the preparation of all the documentation, the bond prospectus, something that's called the operating statement for the town. Just to give you a sense, this is a bonding that we did in February 2022 for 29 million in general obligation bonds. There is a lot of documentation that's associated with this, and our bond counsel and others help prepare this material, but it is a complicated process. So just a quick note, you've probably heard us talk about bond counsel and our bond financial advisor. I don't know if you've talked to these folks. They're very competent and they've worked with us for a long time. Pullman and Comley, they do really all of our bond legal work. And so Marie Phelan, who's been with us and helped us for a very long time, they'll provide a lot of legal and strategic guidance, not just for individual bond issuances, but for really all town debt matters. And her help and her team's help, they'll help us be clear about what expenditures can be spent in a bond with bonded funds, or whether we want to pursue taxable or tax-exempt financing. They'll also oversee the compliance that we have to have for unspent bond funds. Anytime you get bonding done, you have to spend that money within a certain period of time. That's why sometimes you'll see, for example, HHR, we're not bonding it all at once. You'll bond it in tranches so that we're sure that those bonded funds will be spent on that work before we get the next set of bonding. And then they'll, of course, prepare and review all the bond documentation that I just showed you. We also have another group called Munistat. Mark Chapman, I've known for a long time. He's more of the numbers guy, and so he'll do things like developing bond amortization and structure schedules, so what your payments would be at different interest rates, at different durations, and helps us think that through. He'll also support the Moody's rating review. Keep in mind that most of their work is to simply update documents they already have in place, but he plays a key role in all of that. And of course, he manages the actual sale process. And when the day comes for it to be sold, we're required to take the lowest bid. and like we are most things. And when that happens, it's actually the lowest interest rate is what we're looking for. So in other words, the buyers of these bonds, who's going to bid the lowest interest rate, which means that'll cost us the least amount of money. There's some other complications to that I won't go into, but when we have that final bidder, we'll take that bid, we'll have some signatures, and then the bond closes about 2 weeks after that sale. So it's about a 90-day process from when the finance director says we're ready to go with a set of projects that we want to bond, to actually get through that whole process, bond documentation, ratings review, actually go out to market and sale day, and then to get to that close is about a 3-month process to make that work. So we are very well served by these professionals, by the way. They help us keep on top of things in ways too numerous to tell you, but I've worked with them for a long time. We are very well served by those professionals. Some people have asked about our bond rating. Right now, Darien, we just get bond ratings from Moody's. There are other groups, Fitch and S&P, that also do municipal bond ratings, but we just work with Moody's. There's multiple agencies, and as I said before, they'll review us on at least an annual basis if we don't do a bond issuance, but they will re-review and re-rate the town anytime we go to market with new bonds. And as I said, that's a $50,000 process, and we don't want to do that any more often than we have to. They have criteria for determining all this, and I'll go through them briefly here. One is leverage, which is how much leverage does the town carry? How much debt do we have? And they've got criteria for assessing that. And they'll also assess the financial performance of the town. So how much is our fund balance as a percentage of our budgeted revenues? And then how much is our liquidity as a ratio? Those are all areas that we can manage pretty closely. These other 2 points down here, institutional framework, which really has to do with the relationship of state government to the town, and whether as a town we have the freedom to raise revenue or we face some kind of restrictions. We don't really have any of those right now, and it's a pretty stable situation at the state level. And then the economy. One of the things about this town is this is one of the richest towns in the United States. And our economy, as measured by resident income, the value of our real estate, economic growth of the town is so strong we actually get extra credit for that in the rating process. But that's probably the most important thing. But the things that we cover really are at the top: leverage and financial performance. The question is does the leverage now that we're facing really affect our rating? I will say no, but I will explain more of that in a minute. And then the last point here, let's say we did get a credit rating downgrade. What you see here are the different levels of ratings from Moody's. So you can get AA, single, or AAA like we are now, AA and single A, and there's some gradations of that. But what you see on this page is that the interest rate difference, these are approximate rates I pulled yesterday in terms of what 20-year bonds, for example, right now the rates on those bonds, 3.85% for AAA, 4.05 for AA, and 4.30 for single A. Basically, even if we got a downgrade, we're only looking at 20 basis points interest rate difference. So we don't want a downgrade. I don't think we'll get one, but in terms of impact on our cost of borrowing, it's actually going to be quite minimal if something like that ever happens. So let's talk about all that now in the context of the current debt situation. So I asked some questions before when I did this in February, and let's get an update on that. So how have our debt levels trended over time, and what projects are contributing to our current debt load? So I showed this chart before, and what you see here is how our debt's trended over the years. So starting in 2022 and then 23 through 25, it's grown a lot, 280% higher than it was in June of 2017. That's a lot. There is one thing to note in here is that I've included in these debt figures the bond anticipation notes we have for Great Island. We're going to convert those to permanent financing later this year. But what you can see on this chart is it gives you a sense of how this debt has grown over time and what it was at the end of June earlier this year. So what are the contributors to that debt level? So you see on the left there's the $62 million from June of 17. We borrowed $7 million for Highland Farms, Ox Ridge at $48 million. And some of you may ask, well, I thought that project was about $57 million. That's true. The reason it's less is that we did receive some state grants to cover the cost of that project, like we will for future school renovation, but also there's some bond premium built into that, again, that reduced our borrowings to about $48 million. We've got about $76 million outstanding for Henley Holmes Royal project, call it $90 million for Great Island, and some other gets it up to $301 million. And then over that period from June of 17 to June of 25, we've paid down debt by about $64 million, which gets us to the 236 you saw on that other page. So in terms of just what's sitting in June of 17, back at that time, we were still carrying debt at that time from the high school and Tokenique Elementary School, the police department, and a few others, but that's where that $62 million came from in June, and a lot of that even has been paid off since then. Okay, so then the next question, what additional debt might we expect to take on in the next few years? Additional new projects, additions to existing projects, and what might those be? So this is an update of presentation of the data that I gave in February. So let's take a look at some of these categories. First thing you'll notice at the top, I've done this not just from 2026 to 2032 like I had last time. This analysis goes now out to 2040. So we have a longer term view. So the first is our fire vehicles. We're estimating $2 million each and doing one every year over that time period. Flooding, we talked about this before. That's the Salt Box and Grove Street projects with the state grant of $500,000. I'm still forecasting that's about $10 million based on what Public Works is telling me. We won't have firm numbers on those projects till we put them out to bid. Pear Tree Point, we've just done that. I had 7 last February, and so that's at 9 right now. The Coons lot, I've built that into this analysis. That's our accepted offer, about $5 million. You note that I've took out Weed Beach, which we had in there for $2 million, so that's gone. And then the other that I've got there for $33 million, that's basically the sum total of all the town capital spending that we typically bond per year, and that's kind of a run rate, and I just said I'm going to project that out through 2040, and let's see what we get. And then finally for Great Island, I had 50 last February. My guess is that from the Board of Finance discussion and probably some discussion with some of you, there's a real interest in slowing that down even further, and this $2 million that I've got here really does the early access for just parking, which is what the Board of Finance was looking for, and that Northern Causeway Road access. It'll solve the problem of getting a vehicular access for folks with mobility issues, but it doesn't carry it any further in terms of renovating, for example, the root cellar at the greenhouse to put in the bathrooms or anything like that. So I think you can get all that done, plus repairs to a few buildings for about $2 million. We're not ready to come with a formal plan on that yet, but that's what I've got as a placeholder for what we'll spend on Great Island for quite some time. Not to say we can't add to it, but I think that's the minimum that needs to be done now to get people onto the island who require vehicular access. So all told, that'll be about $88 million through 2040 for town bonding. For the schools, we got HHR, another $2 million, that's what's remaining. I did communicate with Dr. Byrne, who's our interim superintendent. He spoke with architects about what it would take to modify and renovate the Middlesex Middle School. He's forecasting to be between $75 and $90 million to get that work done. They're going to have to replace the HVAC systems. There's a lot of work to do to Middlesex to get it to the standards that we're having the HHR elementary schools renovated to. I've put in $75 million. That's probably at the high end because I've tried to take out a forecast for what grants would be and maybe bond premiums associated with that. I'd be surprised if the net figure to the town ended up being higher than $75 million. And then there's roof repairs, there's other capitalized maintenance that we forecasted for the schools. So all in all, $111 million through 2040 for the schools, for a total of about, call it $200 million in additional borrowing, from the 236 that you see here. So what does that mean in terms of additional debt and debt service requirements, and how does that look like? What does that look like over time? So just a few caveats on how I did this. We're assuming 20-year debt for all the future bonding. The same structure I talked about before, interest only for 2 years, followed by principal and interest. We're going to use current interest rates in the forecast. I've made no attempt to forecast something different. We're going to convert those bands I mentioned to amortizing debt next year, and I'm not assuming any refinancing, which I did a lot of when I was on the Board of Finance, but we could get some of that could reduce our cost. And just keep in mind, there's cost uncertainty. There's inflation. We've seen a lot of that in some of the projects that we've done, and so I've made no assumptions for that. There's timing uncertainty. We don't know when some of these projects might start, and there may be some investments that I'm not forecasting here, but this was the best I could come up with. So this is what that debt profile would look like. So the Middlesex School, and talking to the superintendent, he put in as a placeholder that we would start that project in 2030. And so over 2030, 31, 32, that's when the bonding for that project would be layered in. So you see that 236 there on the left where we are right now. It gets up to about $316 million, taking into account that project, before our debt levels start to come down and get back to something normal. And you can see that process will start right after the middle school is finished. And then over time, our debt levels would start to calm down and get back, start to trend back down. It's going to be a long time before we get our debt back to what it was a few years ago, but in time that can happen. Now, what about debt service as a percentage of the general fund budget? Well, for last year that ended in June, it was about 6.2%. That's going to grow to a high of about 12.4%, twice as much as what it is right now. This is assuming that the rest of the budget grows at about 4% per year, and you layer in the debt service for the debt that I just showed you on the previous slide. So again, it's going to grow. It'll start to come down. It'll start to get more under control, but it's not something that's going to come back down to what it was for quite some time. One thing I would point out, you're going to be talking about the Coons parking lot later on, and one of the issues raised as to whether we could spend the $5 million on that lot. The thing that that's driving our debt is Great Island and $250 million in schools. We're spending $100 million on Henley Holmes Royal. We spent $60 million, call it, on Oxridge, that's $160, and we're going to spend another $90 on Middlesex, call it, $200 to $250 million is what we're spending on schools, depending on, again, state grants and all of that. So that's what's actually changing our debt picture, not the small stuff. And if you were to just say, let's not do the Coons lot, you can see that debt service as a percentage of the general fund budget in 2040 would go from 10.5% to 10.4%. My message to you on something like the $5 million Coons lot in the scheme of this analysis and this challenge we have in front of us is immaterial. It doesn't matter, okay? So in terms of budget impact, I thought I would just throw up some, and we're almost done here, just throw up some numbers here to show you what the compound annual growth rate in some of our spending is with this layered in debt. So what I did was pick two time periods. One was 2023 through 2034, which are kind of the peak levels of debt growth. And you can see our total annual budget, less debt service, it's just over 4% because I've got 3 years where I've got previous year's debt, and that was a little higher than 4%, but it assumes 4% going out through 2040. So you can see annual budget, less debt service, 4.19% for that period, and then up through 2040, 4.12%, so basically 4%. Then you say, how much is debt service growing? Well, over that period from 2023 to 2034, it grows at almost 10% per year, okay, to start to cover all this debt. But if you extend it out over 2040, that drops to about 6.6%. So again, rising and will come down over time. And then of course the total budget, instead of a 4.19% budget, it's 4.66%. The reason I show that is keep in mind our debt service, is growing to 12%, but that's 12% of the budget. That means 88% of the budget is not debt service. And so we are paying more debt service. It's taking up more of our budget. But it's not 50% of our budget, it's not 70% of our budget, it's 12% of our budget. So let me wrap up by saying, does this prospective level of debt threaten our credit rating, and what are the implications for prioritizing capital spending? My last two slides. So there's no record that we can find that Darien has ever had a credit rating of less than AAA. I think that's important to keep in mind. And assuming nothing else changes, and I spoke with Mark Chapman today, his general view is that our debt load would have to get up closer to $500 million in his judgment, and he does Moody's ratings all day, for our credit rating to be at risk. And you see from even this maximal view, we're not going to get anywhere close to that. And as I said before, because of other factors that weigh so heavily in our favor, namely the economics of this town, there's going to have to be a lot wrong with the world before our credit rating is degraded or downgraded for any reason, certainly not the debt levels that I'm showing here. So in my judgment, and again, based on talking to the professionals, I don't think this borrowing, and I feel very strongly about this, is going to affect our credit rating. That said, one of the things we'll need to continue to monitor is our fund balance as a percentage of budgeted revenues. That's an important factor in terms of credit rating agencies' views on the town. And so something that we should all pay attention to, and I know the Board of Finance will do that as well. So that's that. I guess my final slide is just to talk about prioritizing capital for the town. And I'd say, as I said before, that it was school projects and Great Island that changed our debt trajectory. It was not anything else. It's not the other small bonded projects. It's none of those things. So don't think that you've got to turn those projects down because you're worried about how much something that cost $5 million is, because they don't make any difference in the scheme of what I just described. Our debt levels are high, and as I said, though, they're going to get higher, and there's not really anything we can do about that. You can delay something like the Middlesex renovation, but people move here for their schools. They're looking for those schools to be 21st century physical properties, and it's going to be important that we provide those schools to the parents and the students who learn in those schools. And so the Middlesex renovation is something that's going to have to be done. We might delay it a year or two, but delaying it for 10 years or 20 years and not doing it, I would say, based on what I'm hearing from folks, is not going to be an option. So we're going to have to really think hard about that and get the best deal we can for it. But that's something we're going to have to do, in my judgment. But as I also said, by the time that's finished, I don't see any massively large capital projects that we're absolutely going to have to do by 2040. Maybe a renovation on the high school, but keep in mind, by the way, that building's 20 years old this year. I don't see that as requiring the same kind of renovation that something like Middlesex has because of the standards with which that building was built. But if you look at everything else, it's all a choice. We don't have to spend any more money on Great Island. There's a ton of things that we could spend money on, but if they're worried about our debt levels, as a town, we can come in and say, we're going to hold this and hold the line for this time period while our debt levels get back to something more normal. And then finally, I know everybody's worried about debt, but and nobody likes to pay higher taxes. I totally get that. But we're not broke, okay? And so I don't want you to feel from this presentation that it's okay to let our town assets degrade. We all live here for a reason, and it's important for us to recognize that the money that we're spending is going to make the town better. By spending money on our schools, we reinforce the reputation of this town as having Class A, some of the best schools in the United States. People want to move here for that. By buying Great Island, that was not a unanimous decision by any means. I spent some time out there today. It's a magical place. It's going to get quietly and slowly better, but it's going to add materially to the appeal of this town, especially once we get parking in place. That was a clear, good investment for the town. You should feel good about that. The rest of these things are not contributing to the debt situation that we see today. Don't let those assets degrade. It's okay to spend money to make sure that we have the assets that people in this town have come to expect. So that's all I have to say. I'd be happy to answer any questions now. I don't want to have this go on too late. Or if anybody's got something they want to talk about, doors always open upstairs. I'd love to come and talk to you about it. But hopefully you found this informative. And I take this communication very seriously, and so when I see these things, I want to make sure that you have a chance to wallow in the data and see it as I see it. I like to provide some educational background that I hope is helpful to you. And anytime you've got questions, just like Jim's Ask the First Selectman series, we can do it through that. Feed those questions to me. I'll come by and talk to you again and answer whatever questions you've got in the presentation. Thank you for your time.